So I want to talk a little bit about how you're thinking about this sort of choppiness that we're seeing in the markets, but also how it relates to what you expect longer term. Because I know your year-end target for the S&P is still around 5,400. We're above that now, but does that imply you see more downside from here?
Yeah, so, I think the idea is from here through end of year, we're not necessarily going to see this smooth sail straight higher like what we've enjoyed for the first half. I think it gets harder in particular for technology companies, for mega cap tech, because really here we're starting to see these companies price in much loftier expectations. Last year was a different story. Mega cap tech, nobody was expecting anything great. These companies cut capex, they cut costs, they, downsized their workforces. They did everything like from a self-help angle. And then on top of that, we got this big AI surprise. This year, it's, these are companies that are spending a lot of money. CapEx is back on the table for mega cap tech. So they're cutting into their free cash flow generation. They're not necessarily in cost-cutting mode. In fact, they're in spend and grow mode. There's a little bit of an arms race for everybody to spend on AI just to keep up with the Joneses. And I think that's pushing expectations driven multiples. These are high multiples that are now at risk of disappointing. And we saw a little bit of that yesterday. I think it's interesting, as you pointed out, that the Dow and the industrials are holding up better than the rest of the market. And that's our call for the rest of the year, is kind of stick with old school, economically sensitive areas of the market. Because here's the deal. Even though we've only focused on CapEx in chips and, kind of semis, there are a lot of other areas where we expect to see broader scale, long-lived CapEx. And I think one of the most interesting themes in the S&P 500 right now is looking at the fact that regardless of who wins the election, which is the big event in November, we are likely to see support from both sides of the aisle when it comes to moving IP out of China back to the U.S., moving jobs to the U.S., moving manufacturing to the U.S. That has already happened. And what's interesting is that we've seen, half of the economic activity that used to take place between the U.S. and China overseas is now taking place on the ground in the U.S. And that is taxing the already somewhat frail infrastructure in the U.S. So, one of the notes that we wrote recently was the idea that forget about AI and chips, focus on old school CapEx, because this is an area where you really need to beef up the infrastructure in the United States in order to handle all that extra economic activity that nearshoring and reshoring has driven, as well as just firing up the semis and the chips that we need to, keep this AI story going. So I think it's time to move from expensive, crowded technology stocks to less expensive, less crowded industrials, machinery, metals and mining, oil, even fossil fuels could benefit from a good old-fashioned traditional manufacturing capex cycle. And we haven't had one for a long time.
Savita, this is such an interesting point, and I love that note that you guys put out about this whole phenomenon. And one of the charts from the note stood out to me, which had to do with construction spending on U.S. manufacturing and just the huge surge that we've seen there. Of course, as you point out, some of this has had to do with government programs, with the CHIPS Act, with the IRA, and sort of trying to spur some of that activity. Why are you confident that this is sort of an administration agnostic phenomenon and that it's going to continue no matter what?
Good question. So I think the idea here is if you look at actual CapEx spent over the last couple of years, as well as CapEx being planned to be spent over the next 5 to 10 years, a tiny, tiny fraction of it is fiscal stimulus. The rest of it is companies spending on either themselves, tech spending on tech, but also tech spending on, building out data centers and lumber. And it's also about, fixing highways. And these are areas where, the muni market hasn't really gotten bigger in a very long time. It has just sort of flatlined in terms of its size. But I think the idea is if cities want to court all of these new businesses and new jobs and economic activity, they need to make sure they have the infrastructure in place to support that. And I think that is necessitating and maybe hastening an infrastructure spending cycle that is, kind of, as you put it, agnostic of who wins the election, government spending, fiscal spending. It's interesting because we have another chart in that same note where we show that fiscal spend is something like, less than a tenth of overall spending that's slated to happen over the next 10 years. So even a clawback in fiscal spending wouldn't kill the story. It would be, a minor hit, but it wouldn't necessarily crush the story.
Savita, switching gears, another theme investors are certainly talking about, small caps. They're in the green and outperforming again today. Savita, your thoughts there?
Yeah, small caps is tricky. And I think that, the Russell 2000 looks cheap. It looks like it could do well in a more domestically driven economic cycle, like what I'm alluding to. The problem is the Russell is not just, kind of the small domestic plays and the nascent growth stocks that are about to grow up into big cap companies. Small caps have really changed to a much kind of a trickier benchmark. So the problem is that a lot of small companies are former large cap companies that drifted into the Russell over the last couple of years because they can't hack higher interest rates. So our view here is, okay, unless we start to see the Fed really tell us short rates are at peak levels, we are going to cut. In fact, we are cutting interest rates. So I think it's almost like you need to see that first rate cut in order to buy that entire index wholesale, because there are a lot of companies in the smaller cap benchmark that have floating rate risk, that have refinancing risk. Commercial real estate is much more prevalent in the small benchmark than in the large benchmark. Regional banks are still working out a lot of their lending that they've done over the last 10 years, assuming much lower interest rates than what we're experiencing today. So those are areas that I would worry about. I think that there are big pockets of the small cap benchmark that look attractive, but not the broader index overall. And the problem, again, I'll cite a statistic for you that makes me a little bit nervous. Over a third of the Russell 2000 growth benchmark just doesn't make any money. And that is a record high. And I think that is the problem, is that a lot of these companies are really just companies that survived in a zero interest rate environment, but aren't going to hack it in a 5% or even 3% interest rate environment, if that's the run rate from here.
Right, because of course, even as the Fed begins to cut, the rates are still going to be higher than they were in the zero interest rate environment. But speaking about cuts, Savita, I am curious what your thinking is in terms of timing from the Fed, and not just timing, but how long those rate cuts are going to last, where they're going to end up, and then the interplay between that and equity markets.
Yeah, so I think the idea that that the Fed is going to be cutting demonstrably this year is still up for grabs. We're data watchers just like everybody else. I think the idea here is we're probably close to peak on short rates, and the next move in terms of the Fed funds target rate is likely to be a cut rather than a raise. So that's good. When that happens, probably towards the end of the year, I think our economists are forecasting that the first rate cut happens in December. We get one this year and then a few more next year. The terminal Fed funds rate is around 3.5%, but that takes a couple of years to get to. And in that backdrop, I don't worry about large caps, because I think larger companies learned their lessons from the financial crisis. These companies, especially, some of the more cyclical areas like financials, energy, industrials, these companies took advantage of low interest rates and locked in low fixed rate debt obligation. Big banks haven't been allowed to lend, so they've been much higher quality over the last 10 years than maybe the regionals and smaller banks. So even if, rates just kind of creep a little bit lower from here, I think we're in an environment where large caps actually S&P 500 looks pretty well positioned. On top of that, you've got tech companies that are net cash positive. So despite this little mega cap tech hiccup, there are a lot of advantages that tech companies have, just relative to the broader benchmark. And one of them is having cash and returning that cash. So I'm excited about the S&P 500 over the next 5 to 10 years, not necessarily from a multiple expansion perspective, but from the perspective of inflation protected income for all those retirees that have parked their money in in short duration bonds or money market accounts, those investors would be well served moving back into equity income if the Fed does start cutting rates demonstrably, because these are folks that need stocks that they can live off of. They need investments that offer a real rate of return. And that's where I think that large cap companies offer a really significant advantage versus bonds and other fixed income opportunities out there.
Savita, what a pleasure to see you, and so many ideas
Likewise.
for people who are watching. Thanks so much. Really appreciate your time.
Thank you. Thanks for having me.